Hi, this is Randy Finney with Right Side of the Chart, and this is a mid-session update for Tuesday, June 27th, 2023. It is 12:52 p.m. Eastern Time. I'm starting the video, and I'm going to pick up where we left off this morning. Got a couple charts out to you today. First one was on NQ, the NASDAQ 100, and the next one was this one here, the last post I got out to you, ES, showing you this nice clean downtrend line and the positive divergence on this 15-minute time frame, and saying, breakout, that's probably going to trigger some stop clearing, and it has. So I'm going to show you where we're likely to go from here, and what to do going forward. So let's jump over to the active. This is that same chart. I just zoomed in and went down, stepped down from a 3-month history to 2 months, so you can see it a little better. And that's how it works. So it was very well defined, and this is where there's two subsets of buyers, keeping things simple. There's other ones, but you have the longs that step in to buy a bullish falling wedge. You have a nice clean downtrend line, positive divergence. They step in. Then you have those that have been short, and that's where logical stop loss orders would be placed. So you have a stop loss order from a short seller is a buy order. It's a buy to cover to close a position. So you have two types of buyers coming in, and then of course the other ones, which are the high frequency trading programs. They don't give a flip. They're not ever bullish or bearish. They're computers, they're algorithms, they're trading, their programs, high frequency trading. They jump in front of trades, whichever direction the market's going, and they jump in front of those trades in milliseconds and get in out. So they exacerbate moves. So that's why you get those kind of sharp moves on a breakout. And that's it. That's a clear breakout and impulsive. Now, where do we go? Max bounce target right now. I figured would be that level I gave up there, about 441, 44.41.80. We'll call it 44.42. I'd actually, certainly if you're going to target it, should we make it that high, and I would put good odds on a reaction if QQQ or NQ is coming up on some resistance as well. But then you'd want to set your sell limit order a little bit below 44.40 because sellers will usually step in early. Now, with that being said, yes, that is a potential target. Nothing says we can't go higher. But as I told you this morning, I suspect this would be just a quick pop to clear those stops. It's certainly been tradable. You can make a few bucks. I did on taking the breakout and closing any swing shorts. Again, if you're an active trader, and if you're not, if that's not in your wheelhouse or skill sets, just hold tight. I'll give you my opinion. You have your own and position as you want. But I think they'll sell into this today. And I think they're going to do it right about here. I'm going to show you why. So number one, we have a little bit. It's not much. It's really minor resistance. I'm going to draw a line right here where we're at. I'm going to take that line over here and show you, we have, well, if I can draw it, I'm using a circle tool to draw a line. But it was a little support shelf here. Then a nice distinct reaction there, another reaction there. And since we had a couple from below there. So it's minor support, and that's where I think the first wave of selling for today's post-breakout is going to come in, and it may end the whole thing. I'd put pretty decent odds that it will, and we'll get a reversal and a sell-off later today, this afternoon. There's only 3 hours left to go, so it's a nano or a micro call is what I call that. And let's look at SPY real quick. Of course, the ES are the futures. You can go to SPY, the S&P 500 tracking ETF, and it was a beautiful little wedge. That's why I wanted to make sure I got out to you today. Nice, clean downtrend line, lots of reaction. You can count all the candles on there. It's got to be at least 10, maybe a dozen distinct reactions, especially recently. So they broke it out, and that's what happens. You get a breakout of a nice, clean, bullish falling wedge. That's the 60-minute chart. No divergence, as I mentioned earlier on SPY. That's why I suspect, and I'm going to give you the likely reversal points. So I have some resistance minor, as I told you, it's minor resistance right about where we're at. There's a gap here. I'm going to put that line right up on the bottom. See this gap right here? There's the top of the gap there, and we back tested it before we even backfilled the gap, and so that validates gaps are often backfilled, and the tops and bottoms act as support once you're above them. The top of the gap, all these reactions here, top of the gap. Then we drop down below the gap and we back test it from above. So it's been acting as, again, support and resistance on this little 60-minute time frame, with the next even a little more significant resistance there at about 436.50. But again, I'm giving you my best guess as this gets faded now. Whether it'll be a quick fade with another leg up, I'm kind of leaning this way, guys. Like I told you this morning, I think they pop it, I think they'd run. It's a quick, actionable trade if you were, an active trader. It doesn't take, if you trade futures, I don't have to tell you this. It's been a 0.6% run, a 0.5% move in the futures. If you have just a handful of contracts, even just a few contracts of NQ or ES, you're putting usually thousands of dollars in your pocket on that. So that's how active traders, they use, futures are inherently leveraged. And if that's not your cup of tea, if you're a typical swing trader, don't try to be what you're not. Get your, hone your skill sets, and then you can move into the active trading when you have, you have to commit 100% full time, in front of the computer to do it. But this is it. So here's my next support target, 429.63. If they sell into this breakout, and maybe it comes in the form of this, where you have extend that trend line right there, move down, you can back test it there, and then we may have some divergence on the 60-minute chart, and you might want to step in there. As I said, if I'm around at the time, I'll give you my thoughts if and when that happens and we get there. But tomorrow, I know I'll be traveling all day. I can work if I'm not driving at the time. Then I'll just tether on my cell phone, work on the computer. But we usually share the driving on that trip. All right, so this is QQQ. Here's another reason why I think this that breakout's likely to get sold into now, just as it looks like it's getting going, because QQQ, remember this morning, we were not at the downtrend trend line. This is the comparable downtrend line on the Qs off the recent highs. We had hit that 357.70 support. It was these reaction highs here. You have a nice big thin zone right here. I don't know if you can make out my volume at histogram bars. They come out all the way here, there, and down below, but they're real thin. They end right here. That's a little thin zone. It got backfilled there. We bounced, but now we're at resistance. So now, if we do go on to breakout, what you want to look at is that would be bullish. It's a trend line breakout. There's a reaction high right here, another reaction high here, and here. And the way this works, if you just take a very simplistic view, you have this is a textbook near-term downtrend line. A downtrend is simply a security making lower highs, which is what we have right now, nothing more, nothing less, and lower lows, and that's all we have now. So the way it works is you go on, you start taking out this reaction high, then this one. You can take out one, and then you still have that one there, and it maybe looks like this, but you start taking out each and every one. It's incremental. They're incremental check marks for the bullish case, and that say that, hey, guess what? We might have gotten, made a few percentage points on this short trade, but that's it. All it was is a pullback, and they're buying the dips, and now we're going to go to new highs. So I don't think that's going to be the case, but I'm certainly open to it. Like I said, never get married to a trade. That's the kiss of death. And your market can do and will do what it wants. But my job is to share what I see, what to look for, and then ultimately what I think is going to happen and how I'm positioning. And that's where I think we're going to have another leg down to that uptrend line, which has been my target since back here before this wedge even broke down, and since it broke down. I'm talking about the 60-minute wedge. And as I said earlier this morning, we had nice negative divergence on the 60-minute chart here, and we do not have positive divergence yet on the 60-minute chart, just only on the 15-minute time frames there, and of the ETFs, QQQ and SPY. So that's it. So looking for something like this, a good time to, which I did close those. If you took the quick bounce, took that breakout in SPY or anticipated it, or QQQ off support this morning, then not a bad time to close that out, reverse, and now, as an active trader, and or get back into your swing positions for the next leg down. And if not, I gave you levels that, depending on your unique entry, if you are short, from the breakdown, where you want to stop out, whether it's a hard stop above a single level or a scale out, that's completely up to you. NQ, NASDAQ 100, that's my 15-minute chart, just shows that was nice support right there. That's the same level. I'm going to show it to you on a 60-minute chart. This is that comparable level. Is really, really good support. Remember, I have 1, 2, 3 reaction highs. We fell to it. It was a 14,878. Again, covered in the previous charts. That's what we hit yesterday. We had at this point on the 60-minute chart of the futures, RSI divergence made a slightly lower low on the PPO, so technically no divergence there. but we can go on. And if we do go on to get rejected here, come on down to my trend line and or that 14,700 support right there. That would be another leg down. And at that point, maybe we do get some divergence here on the 60, and we'll also hit that trend line, which was remember my initial pullback target from the short here of the rising wedge and the divergent high. Again, I am very, very much open to the fact that this is not just a quick counter trend, short-term swing trade. We're not talking a monster trade here. We're talking about 5% if that target's hit. But I'm also very much open to the fact that this is the start of a much larger move. So if and when the trend line in 14,700 clearly gets taken out, you can see my additional targets on here on NQ, which will lead to a lot bigger drop. So we'll see if and when we even get there. I am leaning that way. I put slightly favorable odds. And the reason is not just looking at this, it's everything that I've covered for weeks now on the long-term charts with my long-term trend indicators they have the potential, at least a couple of them, several of them have the potential to flip for the first time since the bear market started. They have the potential to flip to bullish on Friday when the monthly candles close. Again, I will not be in front of at my desk on Friday. I'll just visit those in case you're catching up. Let me just jump to long-term charts. Let's just look at SPY. There's other. You can look at the Wilshire and equal weighted NASDAQ 100 and everything else. So this is what we're looking at here on the monthly chart. Let me make sure that's what I'm on. Yep. Okay, let me turn off all the lines real quick. And this is what I'm talking about. These two dashed yellow and blue lines are the 20-month simple and the 20-month exponential moving average. And I know if you follow me for a while, you're okay, Randy, we know what they do. They define trends. But again, there's always new folks coming to the site or those catching up. They've done a phenomenal job. I mean, this is one indicator. If you're just, hey, I just want to get ahead on my investing. If you are simply long when the S&P 500 and the NASDAQ 100 is above on a monthly basis, that's the thing. You got to wait for the monthly close. You get whipsawed out. The candle has to print above solidly, not where you have to zoom in with a microscope and did it cross above, and not just one index. Take it collectively, and more if you have the NASDAQ 100, the NASDAQ Composite, the equal weighted NASDAQ, the Wilshire 5000, the S&P 500. The majority of those make a solid close above, then hey, that's a buy signal. It says trend indicators change. But just done a phenomenal job. That was up to that point in time, the longest and strongest bull market, that big one into the 90s. And it was very clear. We on a few pullbacks to test the 20 months. They held on a closing monthly basis. That's why you don't give the signal any waiting intra-month. You wait for it to close. So you would have bought back in at that big drop in the mid-90s. They called that the Asian contagion. There were some things going on in the Asian markets at that point in time, and it was a buying opportunity. It said, guess what? You're in a bull market, buy. You didn't take them out. But guess what it told you? When right after the dot-com bubble burst, they gave you a solid red close, and then every back test under those lines, you got rejected. You would have made you would have, first of all, saved a fortune getting out of your longs, and you would have made a fortune shorting. And then here it said, safe to get back in the water. Here's your 401k indicator. 401k's in cash here, or short if that's your thing, and it's long above. And it got you almost the entire perfect run of that bull run back there to the 2007 highs. There was your breakdown candle. You back tested it. If you missed the short entry on that first drop, it told you to short or get out of your longs on the kickback, and 2 months of back testing, 3 months of back testing. And if you didn't heed the warning, then you got wiped out. Or you made a profit if you did heed it going short. And then you took them back there. Again, I use them both now because sometimes one or the other will do the trick. So you really want to see them. The exponential just reacts a little faster to prices. But again, nothing's perfect. Whipsaws here and there. But usually what you're looking at to be a whipsaw, it's usually just an intra-month break. And that's it. So COVID, you had a sell signal. But then the Fed and the federal government prevented it, would not allow a bear market, even though one was naturally, starting out. And of course, they came in with the nuclear response. And either way, if you took the signal the following month, you close back on the lines, and then you clearly close back above it the month after that. So it said, guess what? It was a whipsaw, or it'll go down in history as one of the fastest bear markets in history, if you want to call it that. It was a 36% drop, high to low, in 6 weeks. So call it a bear market if you want, call it a correction, call it whatever you want. That's it. And what I can tell you is definitively is support, 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 support. We closed that month on it, and there was your sell signal. And we've been back testing ever since. This one is above it now. Like I said, it's not much. We only have 3 days to go after today. Just to let you know what we'd have to drop from where we're at right now, just to get back in close proximity. Again, you don't have to zoom in with a microscope. If you drop anywhere roughly 4% would put you right back on the line. So it would look like this. Here you close the month right on the 20 month from below. Here you close right on it. There you got rejected. And here you got rejected. There you closed on it. So that's it. So it's not, somebody asked me in the comment section, so Randy, you're saying if we close up here, all of a sudden, are you full out long and bullish? No, it's not. Again, I'm going to look at all the indexes. I'll look at I have to be comfortable on the 60-minute charts and the daily charts. Those divergences need to be taken out. For me, the indexes aren't all or none. It's not either you're always either short or long. I like to line it up. Right now, I think the RR is tremendous on the downside. It's one of the best RRs I've seen. Risk-reward ratios on the short side. I think there's very little upside at this point. A blow off top is certainly possible. That's why you don't let a short trade get away from you. But the potential for a quick and powerful downside drop in the coming weeks to even months, I'm talking a drop that could exceed over the next year 50%, in my opinion, or go exceed 30, go anywhere from 30 to 50%, I think is quite likely. Even favorable, above 50% odds on that. And the chances of a 50% upside is almost zero, in my opinion, right now. As close to zero as you can ever get. And anyway, so that's it. So we'll watch this. Again, it's not a be-all, end-all, but it is one indicator, as is this PPO histogram. Does a phenomenal job. When it's green, PPO, that's just telling you the PPO, that's the blue line on the PPO, is above its signal line, the white line. That's these two right here. And when they cross, the histogram tells you when that is. There are periods of, that was a sell signal all day long. And again, it's what I call Ursa Interruptus. They did not allow a bear market to happen. Was priced into the charts. COVID hit. COVID was certainly the catalyst to make the technicals play out. But again, if you have enough money, and the central banks have unlimited printing power, and they and the federal government on top of that, giving everybody checks, it didn't happen. So whatever, it told you that indicator flipped back bullish there, and it says, hey, bull trend. And so where I'm going is we flip early on in the bear market. It said, hey, trend change, bearish PPO crossover, get short. I'm sorry, these not these lines. This is it right here. There's your bearish PPO crossover. And now you might say, oh, well, it looks like we're about to cross over bullish. And we might. That's why I'm saying, I've been saying this for a month now, or over a couple months, because we've been testing that level. It looks like we may, but I've seen many times, especially in bear markets where the PPO goes up, it looks like you're going to make a bullish crossover and the lines reject. That zero line often acts as support and resistance when tested from above and below. So that's it, guys. And we won't know, and we'll have hopefully somewhat of an idea by the end of the month. If the market between now and Friday could rally and close above the recent highs, that's going to be a pretty solid print above there. And again, it's not be all end all, but it is a big check mark for the bullish case if this PPO prints a solid, it would be on this bar right here, a big green bar, and then the SPY, the S&P 500, the NASDAQ, the equal weighted, especially those equal weighted indexes, because we've had that distortion from the market leaders lately. All right, back to the short-term charts. NASDAQ at downtrend line resistance on NQ. Just want to throw up some fibs for you recently. Right now, let's do that. 60-minute chart, Fibonacci, kind of measure the scope of this move. that those help you determine what's a reasonable, if it is just a counter trend bounce. If this near-term downtrend that I talked about continues and there's more downside to come, like I said, you want to stay below these previous reaction highs. Then what is a typical retracement? Well, Fibonacci's will tell you that. On the left here, you have the 61.8, 50%, and 38.2. That measures from the highs to the recent lows. And right now, we're not even to the 38.2 yet, so we could go up a little more. There's that gap resistance right there I told you about. That'd be an upper bounce target zone. And that top of that gap comes in perfectly right here with the 61.8 fib. And the bottom of the gap comes in with the 50% fib. So that's that. Again, right now, as of now, even though you have the breakout, you have the divergences, and those need to be noted. They're playing out as of right now, certainly for trade, but how far do they go, we'll see. That's what happens in a downtrend. It's just like a bull market or a bull trend in reverse, where divergences often either don't play out, divergences against the primary trend. In other words, bearish divergences in an uptrend either don't play out at all, they get burned through, or just as they start to play out and look good, then the market continues to resume its uptrend. And so that's why those 15-minute divergences, I recognize them. They're good for at least a short-term bounce. But it really, for me, I want to see those 60-minute divergences on SPY and QQQ before I consider closing or not getting back into any swing shorts. And when I start to then favor longs, looking to buy dips or buy breakouts. Until then, I'll play these little micro squiggles when they present. But QQQ, just to give you an idea there, from the recent highs to the lows, there's your fib range, 38.2% fib. We're coming up on just like SPY. We're just a hair below it now. 50% fib there. I should use a line tool. I'm using a circle tool and just flatten it out. And there's the 61.8. So that would be a typical retracement zone. Ideally, if we get rejected here at the 38 fib, we would stay below that reaction high, and that's the way I'm leaning, and give us that final shot down to that trend line, and then give you another opportunity to cover some shorts and go long, and at least for a bounce trade. But again, I have to say this, that's my near-term targets I've been targeting now for a little while, this uptrend line and the 354 level, but very, very much open to that level breaking. Or even if we break it, just initially overshoot it, you have pretty good support under there, about 348, maybe back test, and then continue lower. This is my preferred scenario. I just want to say that. If I don't, for whatever reason, don't get anything out to you tomorrow because I'm on the road all day, and then the next day getting there late and, visiting family and all that, then I will just tell you that, hey, if you think that we're going to drop and this may have marked a major inflection point or the possible end of the bear market rally, then, if you shorted here, you can at very least have a stop up there. There's no reason to let a winning trade turn into a loser. You can set a stop at break even, and so nothing ventured, nothing gained, nothing lost. But and then that allows you to give a wider stop and maybe shoot for the that triple or home run or grand slam. The grand slam would be my my next swing targets on the weekly, which is still all the way down here. That trend line I've had forever as a target, but I think at this point we'll probably go on to break the trend line ultimately, even if we get a reaction on it and come on down to that 235-ish target, which again I told you the other day, if that, or even from where we're at now, I'll tell you it's about a 35% drop, and I'm open to the possibility of ultimately in the coming years to see even more than that. But first things first, that's macro or long-term analysis. First things first, let's see how those intraday charts play out. There's your uptrend line. That's the same trend line. You see it here on the weekly chart. That's the one I'm calling for the pullback for that we're in right now. All right, let me keep the video short and just hit on the market leaders real quick. I've said it once, I'll say it 1,000 times. This market is not going down very far unless the leaders break. So we're watching Apple. Apple is actually, it's a trade setup. Just to be clear, once again, a setup is not an actionable trade. It is simply a potential setup pending or needing a objective entry. In this case, it would be a short entry, and that's going to be on a break of this trend line. I always say on the daily trend line, and there's two ways or a combination thereof. You can short a solid break of it. Let's say it's intraday. and or wait for a solid daily close below. The and part would be, breaks down, take a starter short on it, and then by the end of the day, if it looks like it's going to print, before, we're heading into the final hour, it's 3:55 p.m. or 3:50 p.m. and we're well below the trend line, there's little to no chance of it recovering, then you bring it up to full position. Or if you want the more conservative of the two, you wait for that daily close. The problem is there's a lot of hot air in this trade right now in this stock. And when the algos and stops are hit, that's what'll happen. You'll have longs that have their stops under the trend line. Shorts are going to pile in. In a single day, Apple could be down 5%, 6% by the time the day is over, which could take it to, halfway towards or all the way down to our first target in a single day. If you don't think it can happen, just look at these candles that came after we had comparable trendline breaks here. Here's a big red candle there. And you can see these previous, you get these trades that are, near vertical, very steep ascents. These trend lines that are very steep, long in the tooth, overbought conditions, especially with negative divergence. I've covered this one quite a bit. Last time this overbought was here. That happened. This big drop right here. That happened. We didn't stop until we were right here. And the time before that was right here. And from there, we ended up all the way down here. So boom, 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 and I think boom. But as I like to say, support is support until unless broken. And Apple's not broken support. Until it does, the NASDAQ's only going to go down so far. Microsoft, I told you I don't have a great trend line, but the one I do have, we are below it. So that's kind of a meh. So, just use my little check boxes I like to use. We have, I'll get to that in one sec, but it looks like this: Apple, Microsoft, Alphabet, Amazon, NVIDIA, Tesla, and Meta. Those are my big market leaders I'm watching that make up over half the. So Apple, no check mark for the bears. Microsoft, we're on kind of a meh. If I could do it, not a check mark, but not an X. Again, I don't have a great support level. Alphabet, definitely, that's all day long. I was waiting for a break of this support zone, the bottom of which is about 121.32. We broke it, back tested the top of the zone, and then rejected yesterday and followed through today. So that's a check mark all day long. My swing target for Alphabet is 108.37. Do I have a high degree of confidence it'll hit that? Fair degree, but unless I think it'll be a near 0% chance it hits that unless Apple breaks down. So that's how it works. These guys are tied together. Some of them, obviously, this one's rolling over first, but to have Alphabet drop another 7%, it's probably going to take Apple to break down. And if Apple continues up above trend and goes higher, we'll probably come in here and back test, maybe get another short there. So check mark down that one. Amazon, a check mark, but kind of a little bit of a meh, because you have the minor uptrend line here. You have big divergence, and there's your divergence. Breakdown, back test. You can see that a lot better on the 60. Go to the 60-minute chart. There's your uptrend line right here, same trend line. Breakdown, back test, rejection so far. At this point, you want to see it get below that recent breakdown level, the post-breakdown lows right there. That should open the floodgates on Amazon. So it is a breakdown. I'm going to give it a check mark because we're below trend, even though we're a little bit above the breakdown level. No problem. We just extended the divergence that we had in place before. NVIDIA, nope, it's got to come down. And the only support I have, and it's a big, huge support, 375, gives you this island cluster right here. But we need to break 375 and enter the gap. Gaps, once entered, are often backfilled, and it's a big old gap. Tesla, check mark there for the bear case. That one broke down. So we have about half of them, but not the other half. We need to see a little bit more. There's your, you can see it better on the 60-minute chart. It's that same uptrend line right here. Negative divergences. Breakdown, zigzagging lower, that's support, a big old gap right there. It got halfway in the gap, and of course, because SPY and ES broke out, the buy programs are hitting. So they're, Tesla, if everything, SPY didn't break out and got rejected off that trend line, and QQQ didn't rally, then we would have backfilled the gap. But the buy programs are bringing it up. It's the top of the gap now. Gaps once entered are usually backfilled. And so far, Tesla's dropped off the highs 12%. So you're seeing, a lot of these leaders finally breaking down. And not just, I always say this, it's a big difference to me for a correction and an uptrend that's just random, or breakdown, sell signals. And that's what we have on some, but not all of these. And the other big one I'm waiting for, the only two fangs that are really, I've given you official, targets and all that, they're both untriggered, are Apple and Meta. Meta doesn't hold the weighting that it used to anymore. It's not, it's not as big market cap wise or weighting wise, but it's still one of the big ones. It still has a significant weighting, don't get me wrong, and we're very close. We just need to break, solid break below that, and it's super well defined, and a big divergence. And this tells me when that breaks, whether we fall immediately, whether we back test it, marginal new high or not, that we're going to go on and hit, most likely. That's why I gave you 3 current targets down to T3 and additional potential targets. And if I can tell you this, if we get close to these, and this all happens soon, this is where it all ties together. Remember a minute ago I was talking about the monthly charts? So if this happens soon, and those monthly indicators stay on sell signals, and even better, we start to walk back away, and it shows that the markets, we get big red candles on the monthly time frame, or even intra-month. Let's say next month, let's say July is a big down month, and we're solidly back down below those 20s, even if we print a close at the end of this month, on Friday, only 3 days left. Then that shows a rejection off the 20 months, or even worse, a whipsaw. Whipsaws are pretty powerful stuff. Then I'll add additional targets. Other than that, we don't, right now we don't have, we have about not even half, a couple of the fangs giving clear breakdowns, a couple more on kind of meh, not so impulsive or questionable breakdowns, and then some of the biggest, including the most important in my opinion, Apple, still yet on a sell signal. So that's where we're at. And if that's confusing analysis, what it means to me, my takeaway, it's not an all-in moment yet, an aggressive short moment. It is, we've been, able to navigate this short trade down. I've given you levels to gain bounces if that's your thing. I do think there's another leg down coming, but you now know the levels that we need to crack. And again, it's the more of these that crack support, the more market leaders that crack support, the more short-term levels that break support on QQQ, such as today's lows, 357.70, or yesterday's, it's yesterday's candle, the 4 o'clock candle, that's where we closed on that support. So these are, check marks for the bears, break of that, break of that, break of that. These are check marks for the bulls, break of this uptrend line, a solid 60-minute close, break of that high, break of that high, break of that high. That's how it works. All right, so those are levels to watch. I'll wrap the video up here. And by the end of the day, I'll definitely give you updates on everything else I've highlighted recently. Totally wheat, all that. We had the 60-minute divergent high. Wheat was a good time to take profits, do a little pullback trade. Treasury bond. I'll get into all that later. I don't want this video to go an hour. So we'll wrap this one here. Keep it limited to the equity markets and those market-leading stocks. And I'll get another one out to you as soon as possible. This has been Randy Finney with Right Side of the Chart. Have a great day.